Hi there. I'm John McGrath. I'm one of the digital team here at The Agenda, and I'm speaking today with Mike Moffatt, Assistant Professor at the Ivey Business School and Chief Economist at the Mowat Centre. Yesterday, the Bank of Canada announced a surprising decision to cut the interest rate that was already at 1% to 0.75%. Mike, we can see a bit of what big news out here in the Globe and Mail, which was in our office today. Seems to have surprised a lot of market observers. What does an interest rate cut like this mean to the average Canadian?
Well, it certainly was a surprise. Nobody saw this coming. There was a survey of economists that I saw. 36 of 36 said there was no rate change coming. So this could mean a lot of things for Canadian consumers. So if the big five banks and other mortgage discount lenders follow suit, then our mortgages are going to be a little bit cheaper. It'll be a little bit easier to afford a house. The big thing that this interest rate drop caused was a 2-cent drop in the Canadian dollar, which will help our exporters, but it will make imported goods a little bit more expensive.
You mentioned the if it's followed by banks and other mortgage lenders. Some have already signaled that they're not going to chase the Bank of Canada on this, that they're going to hold back. We've heard these kinds of promises before. Is that really a credible promise from these banks?
Well, I think they may blink at some point. We're already starting to see the discount lenders lower their rates a little bit. So if the big five banks start to see more and more people go to mortgage discount brokers, then they may start to follow suit because they'd be worried about losing business.
And this interest cut comes after the Bank of Canada has made several warnings about the debt loads that the personal debt that Canadians are racking up. Is the Bank of Canada sending mixed signals here?
They are a little bit, but that's natural in monetary policy. Monetary policy is always about walking a tightrope. So on the one hand, the Bank of Canada wants to lower interest rates so they can stimulate the economy, so they can lower the Canadian dollar, help exporters. But on the other hand, in so doing, you create the conditions for people to take out more and more loans, something that the Bank of Canada has indicated many times that they're worried about. So what the Bank of Canada had to do here is decide which was the bigger problem, and they clearly signal that right now they see the economy as being a larger problem than household debts.
And why is the personal debt load of Canadians such a concern for the bank?
Well, the big concern is that interest rates are probably going to start to go back up at some point once the economy is doing better. So you have all of these households racking up all this debt. Those interest rates on that debt are going to start up, whether that be credit card debt, car loan debt, or when your mortgage rolls over every 5 years. After that, those interest payments go up. So there may be problems where people have just too much debt, they can't afford the payments, and start to go into bankruptcy. So naturally, this is something the Bank of Canada would like to avoid.
And since 2008, the Canadian and American economies have really taken a different path. Since 2008, the Americans have really used low interest rates to get out from under some of the personal debt that they've racked up. Whereas Canadians have really piled on more debt in the form of larger mortgages and things like that. Is there something that explains why the U.S. and Canadian economies have gone two fundamentally different ways?
Well, I think the household debt portion is largely due to the fact that the Americans had that housing bubble, a lot of subprime mortgages, and that whole system collapsed, knocking house prices down significantly, and you saw a wave of foreclosures. That hasn't happened in Canada, and that didn't happen in Canada. Now, it's a bit of an open question. Are we setting ourselves up for a housing bubble the same way the Americans had? But that's really the big difference. That in the United States, house prices collapsed, the housing market collapsed, which allowed the bank to, the Federal Reserve, to lower interest rates beyond zero without worrying about house prices too much. Bank of Canada doesn't have that luxury. That we're already seeing house prices go up and up and up, and they want to avoid fueling that any more than necessary.
Mike, thanks so much for your time today. I've been speaking with Mike Moffatt, Assistant Professor at the Ivey Business School and Chief Economist at the Mowat Centre.
Thank you.